Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, June 13th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I'm just a guy on the internet. Please do your own due diligence. It's your money. It's your responsibility. Before we get started, just want to plug the channel. I do see the analytics, and a lot of folks that do come here and enjoy this content, or maybe don't enjoy it, but if you would do me a favor, like, share, comment. We also have in the show notes, if you go down, if you're interested in my free email that comes out every week, basically you can get on that list. It's once a week email that comes out, usually Monday, Tuesday, or Wednesday. And it's basically all the things that I've been reading or stumbled on or that I find interesting. It could be a video, could be a quote, could be an article. A lot of people find that useful. And it's kind of an introduction, I guess, on, what I'm looking at. And it kind of ties into these weekly videos. We talk in general on these videos about the trends and themes that I think have the potential to provide above average returns, and then we distill it down in the paid newsletter to actual actionable names and ways to take advantage of these ideas. So if you have interest in that, all of that stuff is in the show notes. Feel free to click on the links and avail yourself of that. All right, time for this week's information. So one of the things I did, we have a Discord channel as part of the subscription to the paid newsletter. And yesterday we had a subscriber Zoom call. And one of the things I was talking about is this, what looks like now, this imminent move higher in gold and hard assets. And why am I saying that? Well, we have an environment that's setting up that is going to be very conducive, or has shown to be in the past conducive to higher gold prices and hopefully higher gold mining prices, gold mining share prices. One of the things that concerns me, or I've been talking about, is this whole idea around liquidity and central bank actions. Look, I'm not an economist. I'm not an econometric expert, but I do know that in the short and medium term, liquidity and sentiment drives markets. And what I try to do is look at probabilities when trying to forecast what's going to happen in the future. It's not 100% certain the future. And so all we can do is kind of try to do some pattern recognition, right? Things that have happened in the past have certain precursors or antecedents. And if we see those same precursors starting to happen now, we can try to game out what the outcomes are based on what's happened in the past. Now, of course, the past and the present are not corollaries 100%, but that's the best we can do. The future is totally unknown. No one can know it. And so this is best guesses based on not gut feeling, but again, if you are dealt two aces in Hold'em and you can figure out the percentage of hands over 10,000 hands, you'll probably win more than 50% of those hands. That doesn't mean you'll win any individual hand. And so I hope you get the gist of what we're trying to do here. So one of the things that, I'm not the only person that's commented on this, but we're getting to levels of deficit spending and debt in this country that are now becoming almost to the point of where they're going to start causing some real problems. And so here's a chart that comes from the St. Louis Fed website. It's called the Fred site. They have all the economic information. It seems like each one of these Fed banks, regional banks, has some kind of expertise. But this is, if you go to the St. Louis Fed site, you can get this. They have every kind of data point you could think of. You just put it in the search and something will pop up. So this is basically the federal surplus or deficit as a percent of gross domestic product going back to 1930. And what I wanted to point out here is this is World War II, basically, this time frame here. And at the time we were running deficits that were equal to more than 25% of GDP. Now that makes sense, right? We're in a world war. We were fighting fascism and the Japanese Empire. So no expense, no hardship, nothing could be spared because we had to win the war. So you can see what happened there. And then as you see, you go along and you see, different times where there was deficit spending. It didn't seem to get, it was anywhere between, not really too many surpluses, as you can see, but the deficits were less than 5% for the most part. Then something seemed to change after 2000, and we started running these regular deficits, and they started becoming, especially after the financial crisis, we had a spike down to 10% of GDP in deficit spending. Now that makes a lot of sense. That was the great financial crisis. A lot of, support had to go out, what have you. And then you see as you recover that the deficit spending goes down. And then you see the pandemic, same thing, right? They sent all the checks out. We were running 15% of gross domestic product deficits. That's World War II level stuff there, right? And I guess you could make the claim, you shut the economy down, and so they supplemented everyone with all this freebies and checks, and of course there's a whole bunch of fraud around that. And you see that actually, after that kind of ran out, we kind of V-shaped out of that. But, we're still now in this more than 5% of GDP, supposedly when the economy is growing, when everything's fine. And that's your CHIPS Act, that's your Inflation, Reduction Act, your Green New Deal, all of that. And so it seems like we're stuck in this perpetual era of constant deficits. And I've talked about this before. And so the problem is not any 1 year deficit isn't really a big problem, but it's cumulative, right? Because if you run, $1.5 trillion deficit, it gets added to the already enormous debt. Okay. And the debt keeps accumulating. And when the Fed has raised rates from basically a decade of zero rates to 5% or 5.25%, this is the problem that you start seeing, right? Interest expense on U.S. public debt. I've talked about this before. I mean, basically, since they started raising rates, this thing's basically went at a 60-degree angle up with no, it's not rolling over because it keeps spending more money, and the debt is rolling because debt matures, right? And so we've talked about this before. 9 trillion something of debt needs to be rolled, and it's being rolled from lower interest rates into higher interest rates. And the part of the problem is we have so much debt now that has to be rolled of the debt that matures, plus you're adding $1.5 trillion or 2 trillion a year. You can't term this debt out. You can't sell long-term bonds. You'll overwhelm the market. And in a free market, if a government tries to do that, that's where the bond vigilantes would come in, right? They would say, okay, well, this is an out of control government that has a legislative branch that will not control spending. And so here's what we're going to do. We're not going to buy your debt, your long-term debt at 4.5%. We're going to require 6, 7, 8, 10%, because that's what the bond vigilantes did back in the day. And so that's not really happening, right? And so there's no mechanism to correct this bad behavior that these politicians have. Again, we've talked about this before. They're in a situation, there's nobody up there advocating for any kind of fiscal responsibility. Maybe one or two people that are considered cranks, like Rand Paul and maybe Thomas Massey, but everybody else just wants to spend. And both presidential candidates are basically MMTers. They just want to spend money, but on different things. One wants a lot of tax cuts and defense spending. The other one wants all this other stuff, Green New Deal, and, building chip factories in Arizona. I mean, really, so this does a couple things. Number one, it's inflationary. Okay. Number two, we're getting to the point now where we have the total debt for the United States is well over 100% of GDP. You start getting into this 100, 110%, 120% of GDP on the debt. You start getting into like what happens in emerging markets where they start getting in trouble. Okay. And so that's why you're seeing, we're kind of on shaky ground. And this is why, in my mind, Mr. Powell wants to cut rates. okay? Because they can do the math. They can see this chart too. And they see that the debt that they have to roll with the continued deficits can't keep rates at 5% and have Janet Yellen selling all this debt into the T-bill market. Because if they tried to term it out in 10, 20, 30, I mean, they couldn't sell the bonds. People won't buy them and the rates would skyrocket. And so we're running out of runway here, basically. And so my point is, I talk about the big bazookas to take it back to the liquidity. We're seeing the majority of central banks now around the world cutting rates. A lot of the G7 banks, I think there's only two banks now, the Bank of England and the US Fed, which really haven't started a rate cutting cycle. And I think that's going to happen. And so we have to ask ourselves what happens in the context, or what has happened in the past. I talked about it in the newsletter last month, in the July issue, this month, that typically when the Fed begins a rate cutting cycle, if they do it because there's a recession or a credit event, the market goes down substantially. The stock market, the S&P, goes down substantially. I'm talking 30, 40, 50%. And this is one of the most overvalued. That's pretty typical. If they cut rates, which isn't that often, if they cut rates in a context where there's not a recession, the market actually goes up. But that's not normally why they cut rates. They normally cut rates because they see there's either a recession happening, it's coming, or there's some kind of credit event or liquidity event where they have to liquefy the system, i.e., like during COVID or when they had the great financial crisis. Okay, so I'm not suggesting we're going to have another 2008. I'm not suggesting we're going to have, what I'm suggesting is that we have the majority of central banks cutting rates. The U.S. was one of the last ones to, remember, inflation was transitory, so they were one of the last central banks to begin raising rates. And so they're at the tail end. And so I think it's coming, maybe not in July, but probably September. And you're seeing more and more discussion now around these rate cuts, and you're starting to see the asset classes that respond positively to rate cuts have started to move in the last week or two. We've had, gold's over 2,400 again, silver's over 30. And so we're starting to see maybe some front running. So I want to show some information, what has happened in the past. I'll go back to that in a minute. So this is from Incrementum, Ronnie Steufel's shop, In Gold We Trust. This is charts from there. So this is basically gold in US dollars and Fed funds rates. So you go back to 2000 when they did some rate cuts, had a rate cutting cycle. It began, and you see that they cut rates basically from above 6% all the way down to 1%. This was after the tech bubble blew up. And you see that gold advanced 31% during that time frame. That's pretty good, right? It's not spectacular, but it's decent. And then you saw something similar during the great financial crisis. The Fed began cutting rates. Notice one thing about when they cut rates too. Notice how it's a stair step down up and then an elevator down. So once they start cutting rates, it's going to go pretty quick because you're cutting rates for a reason. Typically because like I said, you had some kind of economic recession, or there's some type of catastrophe in the financial markets, like bank failures or a liquidity event. And so anyways, during this great financial crisis, we saw gold advance 39%, okay? And you'll note when they first start cutting rates, even gold moved down at first. So, but during the course of the rate cutting cycle, gold moved, these are pretty decent moves. And so you go and look at the COVID situation or pandemic, and they had that rate cutting cycle you see, and gold was only up 5%. So I think, we've raised rates now to a place that we haven't seen in 20 years. We have a bubble that's as big or bigger than what was present in 2008 or 2000, or equal or greater. And, we're in a different spot now with our debt and some of the other things that are going on. And so are we in a situation where, gold's being remonetized around the world, okay, by central banks, at least in the global South and East. And so, we have a different situation, right? Where a lot of other things are pressuring or lining up to be positive for gold that weren't present during these other cycles. So we do see that during rate cutting cycles, at least, we can suggest that gold does move higher. Here's same chart from the same, different chart on silver from the same folks. Silver tends to react even better. I mean, you see the rate cutting cycle during the financial crisis. You see the move in silver over that 8 years. The great financial crisis, they cut rates. You see how silver moved during then. Same thing, the great financial crisis or the pandemic. You see, you're talking 412%, 441%. This is just the silver price. And so it looks like silver might even be more leveraged to these rate cutting cycles. And so if we're entering another rate cutting cycle, is silver the place to be? So I'm just, again, pointing out what's happened in the past. That doesn't mean the same thing's going to happen now, but I'm just wanting to show you that where their opportunity could be, it's certainly not going to be in these tech stocks. Okay, they're going to get killed on the next downturn. That's what we've have seen in the past. Okay, and I think you're going to see a rotation, like I've said before, into out of tech and into value and into resource stocks. So what have the gold mining companies done during these times? So during the 2000 tech wreck and the rate cutting cycle, gold mining shares, as represented by the HUI, which is the general, not necessarily specific juniors, but your larger, more higher market cap gold stocks, was up 267%. So during the great financial crisis rate cutting cycle, the HUI was only up 26%, and during the cycle of the pandemic rate cutting cycle, the HUI was up 29%. So I think there's potential there, and I think because gold shares have really underperformed recently, that we may see a better result during this rate cutting cycle. And again, your results may vary, right? Your mileage may vary depending, this is the actual index. Individually selected, well-selected gold and silver stocks will probably do better or worse, So I just wanted to show that what our expectation is here. This is a place where I think you can make some money, or definitely where I've already positioned, and I'm going to be positioning more. We've already seen some of the large cap gold stocks are already moving. I've mentioned Anglo Gold Ashanti on here before. It's made a new high. If you look at Newmont, it hasn't made a new high, but it seems to be pushing higher from a bottom. Again, I think you have to select well-managed companies, and I think a lot of the money will initially go into the large cap stocks. And if we do start seeing a gold stock rally, it'll become a shiny object. And then I think you want to migrate out of the large caps if that happens and start working your way down the market cap into the intermediates and into the juniors. Again, this is another variation of a chart that I've shown before in the last couple of weeks. Is I want to prepare people mentally. There seems to be this view that this market's going to make all-time highs once they start cutting rates. That is not typically what happens with the S&P. Historically, when the Fed cuts rates, it hasn't been great for stocks, okay, as relates to the S&P 500. There will be stocks that will do well. I talked about this on the Zoom call with the subscribers yesterday, okay? I'm not going to get into all the specifics, but in general, and this was in this month's newsletter, paid newsletter, I showed the data, which basically backs this chart up. If the Fed cuts rates because of a financial crisis or a recession, the stock market goes down typically. And you see the drawdowns aren't, can you ride out a 41% or a 50? This is just the index, not individual stocks. They're talking about the actual S&P index, down 41% after the tech wreck, okay? The NASDAQ, I think, was down 80% after the tech bubble blew up in 99, 2000. At the great financial crisis, the S&P was down 55% after the Fed cut rates. And similarly in the pandemic, which is kind of a one-off. And so we're really extended on the upside. So when they start cutting rates, what can we expect to see here? Well, I can tell you that there's going to be a rotation out of the high flyers and into, it'll go somewhere. And I think it will go into those sectors that have underperformed: energy, mining, other value stocks. Small caps made a huge move here this last week. So these are areas that have underperformed. And so I can't say with certainty that the S&P will go down during this rate cutting cycle, at least initially. But, what we see is it goes down, then it recovers. And so what I was telling people is you better go look in the mirror in the next week or two and understand what your EQ is and what your emotional ability to absorb losses are. Because if you just have a 401k and an index fund, can you sit there and, if you're in your 60s and you've got huge profits, can you endure a 55% drawdown? Because what will happen to a lot of people, if you look at the long-term chart, you'll see they'll cut rates, they'll liquefy, the market will eventually recover, okay? Maybe for the most part, hopefully. But if it takes several years, what does that do to your plans for that money if it was put there for retirement? So people get greedy, okay? And are you in a position, if you're in an index fund, or if you're just in S&P or these high flyers, which are even going to have even more beta, or more, they're going to move more relative to the market because they're volatile. Will you be able to endure a 41 or a 55% or even a 24% drawdown? And I'm not saying that's going to happen, but it needs to be considered because this is what has happened in the past, in the recent past. I'm not reaching back to the 1890s here or the Great Depression. I'm talking about the last 25 years. We've had 3 major drawdowns in the stock market, 2 of which were, one was 41%, one was 55%. Now it came back, but can you endure that? Will you endure it, or will you not be able to take the pain and sell at the bottom? Because that's typically what most retail investors do. And I can tell you this, if you're invested in these junior resource stocks, and that includes uranium stocks for the most part, if we get a stock market pullback, significant one, most stocks will go down for some period of time. Now, I think like in the past, a rotation will take place and the stocks that we're involved with in the AIA portfolio won't go down as much likely, and they'll probably recover first. But they still probably will come down. In a stock market pullback, bear market, most stocks go down. 95% of stocks will go down. That's just how it is. Now, somebody asked me on the call, well, shouldn't we sell now and then come back in? Well, you could do that. Do you know 100% that we're going to have a drawdown? Do you know that for a fact? No one knows the future. And so my advice is I want to have my core positions. Do I want to lighten up? Do I want to put new money to work right now? No, I'd rather just get T-bill interest at 5.25. Nobody's cut rates yet, but I want to have a buying list together of things that I want to buy because I know what's going to happen. Okay. And I already have core positions in various gold stocks. I already have my positions that were bought, very cheaply. Emerging markets are going to benefit from a decrease in interest rates here. Why? Because as the dollar comes down, or as the rates come down, the dollar will weaken. Okay. Because other central banks around the world have been cutting their rates. And this stuff is like I've talked about before, relative intermarket relationships. So I think over the weekend or this next week or two, people need to really be thinking, at least before like August and September, because I think there'll be 2 rate cuts by the end of the year. Definitely, I think they're going to start in September. Mr. Powell wants to deal with this. This is going to become a problem if they don't start cutting rates, because they have so much debt to roll. They can't keep rolling it at 5.25 in T-bills. It's not. They have to get the rates down and try to term out some of this debt. And I think they're going to have. That's another story for another day. They're probably going to have trouble doing that also, And that's where you're going to end up on yield curve control. But that's beyond the scope of this discussion for today. But just be aware of this, guys. Okay, don't like have this shock you, because I was at the gym today and they had CNBC on there and they're all talking about rate cuts and how wonderful it's going to be. No one puts this chart up and shows, well, that's interesting. Their guy on CNBC that just wants more assets under management, and it's always a good time to buy stocks. During the last 3 rate cutting cycles that we've had in the last 25 years, stock S&P went down initially. Over 50% and almost 50% and 2 out of the 3 times. I think most people can live with a 24% drawdown, but a 55% drawdown, this is just in the index. There's going to be stocks that go down way more than that. So be aware of this. Be aware of this, because historically, when the Fed cuts rates, it hasn't been good for stocks. So I wanted to talk about this. I'm going to put it in the free newsletter. There's a guy named Robert Bryce. He writes a pretty good blog on, Substack about these energy issues. And I just kind of like the hypocrisy of these companies like Google and Microsoft lecturing everyone about climate change and how they've replaced 100% of their electricity with renewables and all this other nonsense, right? And if you go on there, like in Google, for example, they have a policy of if they deem you a climate change denier, they're not going to let you profit from that on their, and in the meantime, here's a chart here that shows Google and Microsoft consume more power than 100 plus countries. So it says right here, Google and Microsoft now consume more electricity than 100 plus countries. In 2023, the 2 tech companies both consumed 24 terawatt hours, it's trillion watt hours, of electricity, more than the entire country of Iceland consumed. Okay, so I mean, here's other countries like Nigeria has 300 million people, and they're closing in on that. So, a lot of these countries are kind of small, Ghana, Dominican Republic, Tunisia, but there's still like 10 million people that live in the Dominican, or 8 million people live in the Dominican Republic. So this is a big deal. And so this is the other thing I want to point out here. This is why we're going to have to go nuclear. If they really want to have these data centers and all this stuff that they're talking about, that's why you've seen the whole zeitgeist change around this whole narrative about nuclear power. Now, I don't want to extrapolate linearly data center growth and power growth. That's what people do, right? They get into the whole Kager thing and it's linear thinking. It was the same thing in electric vehicles, and that didn't pan out. And so, yes, I believe there's going to be growth and demand growth, and I believe it's going to expand. But I wouldn't bet my life that it's going to be as everybody, has suggested it might be. But I wanted to point this out because this is kind of interesting, actually. So I just talked about it earlier when I was talking about buying undervaluation, things that are undervalued, things that could perform during a Fed rate cutting cycle. And I think emerging market equities are really poised to really do something here. We've talked about this before. You're at 50-year lows. Emerging markets are at a 50-year low versus the US. I just see tremendous opportunity out there. I am looking at a ton of companies that are performing very well, that have tremendous prospects, and they're super cheap relative to the US. And that doesn't mean they can't stay cheap. A lot of these places have issues. That's why they're never going to reach full parity with the US, at least in the near term. But it still has tremendous opportunity. And I think you can see, as I've pointed out before, that these cycles of emerging market undervaluation, overvaluation seem to go in these 10-year cycles. I think, we're at a place, if you look back to at least the 1950s, where when you get to a 1 standard deviation undervaluation relative to the US, this seems to be a turning point. Now, it could take a couple years to turn, but, I can point to, off the top of my head, a dozen companies that are growing, have good balance sheets, are paying double-digit dividends in some of these emerging markets. It's like, Why am I messing around here with overvalued stocks in the US when they have all this, and that's where the growth is in countries and places that you can make an argument are going to be poised for higher growth. The prospects are better over time. So I think it's something that you should consider as an investor. I don't think most people do consider it, and they leave a lot of money on the table. And so I just wanted to point this out to folks, because I'm going to be talking about this more in the newsletter. I'm finding a lot of companies, and I'm not going to be able to help myself. I'm going to be buying some more of these emerging market companies because I think that that's where the opportunity is. So I thought this was amusing. Again, I just talked about how the EV thing kind of sputtered out. You remember last year I was showing you the charts where they were extrapolating copper demand and lithium demand and electric vehicle demand. And it was this, so many, compound annual growth rates and blah, 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 blah. And every year it was just stair stepping up, and it looks like it didn't happen. So now you have like Volkswagen will invest billions in gasoline engines. So this is an article, I don't remember where it's from, but it says the shift to electric vehicles hasn't unfolded as some automakers originally envisioned. Several manufacturers are pushing back their ambitious plans to achieve complete electrification in the near future. Out of the $180 billion designated for research and development in 2023, Volkswagen plans to allocate over 2/3 to electrification and digitization. Speaking at a Reuters event in Munich, the CFO and COO stated, "The future is electric, but the past is not over. It is a third, and it will stay a third." This reiterates Volkswagen's earlier announcement from late 2022 that the company aims to go fully electric in Europe by 2033. Well, we'll see. I think that, this could be I talked about this also of one of the companies in the dividend portfolio. That's a major European integrated oil producer that's just laid off most of their offshore wind things. I mean, this stuff didn't pan out, right? And so people are starting to go back to their core competencies. I don't think a company like Volkswagen is just going to turn on a dime, but this is an important realization and admission that things aren't what we originally thought they were going to be. Going on for the last snippet, it's evident that more automakers are reassessing their EV strategies as consumers remain reluctant to abandon internal combustion engines. This puts car companies in a difficult position as they must invest in making gas engines cleaner due to the increasingly stringent emission regulations. You know what this also tells you should be buying? Platinum group metals. I just did an interview with a guy from Bulgaria, and we were talking about this, and you've seen other folks talking about this on Twitter and in other Substacks and blogs. There's a handful of companies, you can name them all, right? Sibiane, Stillwater, Impala Platinum, Sylvania Platinum. There's not that many companies. Or you can just buy the metal. The metal's cheap, platinum relative to gold. And what is platinum as far as scarcity? Something like 10 times more scarce than gold. And so, there's been tremendous underinvestment in platinum group metals. If the ICE is not going away, then emission standards get tightened. That means more platinum. This is kind of like, kindergarten thinking about it, but I'm just trying to lay out the thesis and looking for something that's cheap. So something, platinum group metals have been knocked down forever. I mean, I think platinum's been below $1,000 an ounce or hovering around $1,000 an ounce for years. And so I'm actually have been accumulating it as part of a dollar cost averaging plan. And I'm happy to do that because I understand that it's a very difficult metal. And think about where the majority of platinum group metals come from, right? South Africa, or the Bushveld area in South Africa, which slightly goes into Zimbabwe also, and then as a derivative in Russia from the huge nickel as a byproduct of the huge nickel mining operations in the north of Russia at the Norilsk mine. So not exactly the two best places that are politically stable or we have good relations with to be getting your platinum group metals from. So I think there's some opportunity there. Other people have talked about it. I'm not going to get into it on this call, but Volkswagen's a major auto manufacturer, and this isn't the first company we've seen say this. Again, I'm starting to see the cracks in the whole ESG. I mean, we're past peak ESG, and so until they get these batteries where you can charge them like you can gas up a car in 5 minutes and the range is there, people do not want to be inconvenienced. It's just that simple. And the cost of these things is still relatively high, unless they let the Chinese just dump all these electric vehicles in the US. Otherwise, the cost is still too high for most people. And they don't want to be, people do not want to be inconvenienced. People are spoiled. That, again, people get antsy if they have to sit in the Chick-fil-A drive through for 5 or 10 minutes. So sitting there and saying, well, I have to go plug this car in. You see these, I always see them, they're building these charging stations near these little clusters of like commerce where they have little restaurants and stuff. And I guess the idea is, you go in and to Johnny Rockets and have a burger while your Tesla is out charging there or something like that, or it's next to a Denny's or a Starbucks. I guess that's the idea. I mean, people are busy. I don't have time to be sitting in Starbucks drinking $7 coffee while the car's out there charging. I want to pull into the gas station, gas up, and go do what I need to be doing. And so I think that I think a lot of people think the same way. And until you get that solution and get the price down, then I think that people are going to be like, not interested. So kind of get into the political stuff now. This is from U.S. Global Investors. I always like their charts. They make really good charts. But it says G7 leaders are deeply unpopular. These are disapproval ratings for these major politicians as of June 6th. And you look Mr. Macron, who did some shicky-micky and kept Marine Le Pen's party. It's interesting when you look at what happened in the UK and what happened in France. These other parties that are outside the mainstream got more votes as a percentage of the vote, but their seats in parliament were not reflective of that because of this unique situations that they have in these laws there. For example, first past the post type situation, and then how they made deals with Macron made with the socialists to pull candidates so that the National Rally candidate would come in second, stuff like that. And so you can play these little games, but I think that I've talked about this before, people in the West, I'm talking about working class people, like middle class white collar workers, things like that. People have had enough. They've had enough of leadership or lack of leadership that doesn't take their concerns seriously and doesn't do what it says. A perfect example, I didn't read, look on the far left, Giorgia Meloni, who's the prime minister of Italy. If you go back and look at her speeches before she was elected, she was going to stop the immigration from North Africa, right? Which is basically, I'm not advocating sinking the ships, but you got to send the Coast Guard and Navy out there and stop these ships. You have to go over bringing these people over from North Africa. People come up from sub-Saharan Africa, they go to the coast, then they have these NGOs that are supported by these Marxist communists and globalists that hire boats to bring them across to Italy and Spain. And, it's very easily solved. And supposedly that's one of the reasons why she was elected. Has she done anything about it? No, because you're not going to get into current way things are structured. You're not going to become getting in charge. You could say this stuff and get elected, and then when you get there, they take you into the back room and explain how it's going to be. And until you break that system, that's what you're going to continue to get. That's what you can, and you look at some of these people. I mean, the disapproval ratings are like 73% for Mr. Macron, 72% for the guy in Japan, Olaf Scholz, our friend, the biggest wet noodle out there, minus 69%. He's got a disapproval rating. I mean, Mr. Trudeau, another, I don't know, I don't even, whatever. And of course, our own Joe Biden here. I mean, and so yet these people are not doing the will of the people, and yet they're still in power. And them or some type of clone gets into power. I mean, so you get rid of Rishi Sunak and the conservatives, and then you end up with Labor and the most boring human ever born, Keir Starmer, as the prime minister. I mean, you cannot make it up. Okay, you cannot make it up. And so what are they going to do? Raise taxes, don't have any oil and gas development in the North Sea, you know, all the wrong policies that are just going to make things worse for the average person. It's you can't make it up. You cannot make it up. And so I want to finish with you know, Viktor De Hanson, Davis Hanson, I think his name is. He's a conservative writer, commentator. He just wrote an article. I didn't put a link to it, but he wrote an article about the comparisons between the Brezhnev era and as Brezhnev was fading as leader of the Soviet Union, and how the, you know, Pravda, the state media, which Pravda means truth, in Russia covered up the fact that, you know, because of all his smoking and drinking and lavish lifestyle, his health went down. So he wasn't able to, for the last 7 to 8 years that Brezhnev was the leader of the Communist Party, general secretary or whatever they called it, he basically wasn't running things. And so, you know, Mr. Hansen was making the comparison about, you know, our old decrepit leadership here kind of being the same way, you know, and how the press is colluding, and how the press in the Soviet Union, what they did. Now, we expect that in a system like the Soviet Union or North Korea, but we have the same type of system here where the press is covering things up. The press is not reporting correctly. Like, it was this big revelation that nobody, you know, and then, you know, you sit there, it's not even sad anymore. It's, you know, for, you know, those who the gods want to destroy, they make, you know, they make mad, right? I mean, you sit there and listen to people get on there on these news channels. I've just seen the clips. I don't have TV, and just justifying like Rachel Maddow and Joy Reid and all these other really whacked out people that, no, don't believe what you see and hear. We're going to tell you that this is the most dynamic, vigorous leader in the history of presidents. He's the bestest president of all the presidents. I mean, really, guys? Really? I mean, in the background, they're trying to, you know, the donors are going nuts, and they want this guy out of here. But then what do? You know, who's on deck? Kamala Harris? I mean, I know there's people out there listening to this who are like, well, I don't know what you're talking about. I think this Joe Biden's a good president. Joe from Scranton really cares about everybody. They did an interview I watched. It was on YouTube. It must have been after this, and they had this whole, I don't know where they went, you know, some town in Pennsylvania or something. They had all these middle-aged and older white women who have to be like the worst human beings on earth. They shouldn't, you know, these are the worst people in America. And, you know, oh yeah, Joe Biden, he really cares about America. They showed him all these, you know, him stumble bumming his way through this. And they're like, yeah, I don't have a problem with that. That's, you know, that's awesome. You know, he really cares about America. He cares about us. We're going to vote for him. Okay. I mean, it's stunning. It's stunning to me. Okay. And, you know, it's unbelievable. So I wanted to point this out because this was like the last straw. So they had the NATO summit, right? And Zelensky got over there. You see how he dresses. You know, this isn't the actual, this is somebody made this meme. But, you know, Zelensky shows up in his fatigues and unshaven. A guy can't put a suit on, I guess. This is part of the shtick, right? I'm in the trenches fighting for democracy in Ukraine, and my wife's Bugatti and my properties in Miami Beach and in Tel Aviv. But anyways, you know, keep the money coming, by the way, guys. And so Mr. Biden was Zelensky was standing next to him, and he was going to introduce the president of Ukraine, and he introduced him as the president of Ukraine, President Putin. And it was just funny. You can find the video on YouTube. Just put it in there. Just put this in here. Biden introduces Ukraine's Zelensky as President Putin, and the expression on Zelensky's face is, I mean, come on, guys. This is not good. Okay, this is not, you know, This isn't what a world power does. This isn't like what competent people do. This isn't how things should be run, you know? And so our choices is an 81-year-old man that's spiraling down in, however you want to look at it, dementia, Parkinson's. People have said different things. Obviously, mentally challenged at this point. Some people make the argument that Biden's always been mentally challenged, but you know, it's not a laughing matter to watch somebody just basically. If you've ever seen anybody in your family that's had dementia, it's not really cool. And then just looking at the cynicism and just the lust for power, right? That family has, that Jill Biden, you know, they've got this guy cordoned off now. There's this internal battle. Joe's not going to leave because, you know, you lose all your power and privilege. Who's going to care about Dr. Jill Biden? And then they got Hunter in there. Hunter Biden's in the White House now, uh, you know, ostensibly looking after his dad. That, you know, if you read the laptop stuff, I mean, these people hated each other. You know, it's just a really sick and sad state of affairs. And then to add insult to injury, Mr. Biden, I'm almost laughing here because this is just like, I mean, what else are you supposed to do? You can't get mad about it at this point. It's just unbelievable. These people are like, who's running the show? And so Biden goes on and he's saying something about the vice president, which is Kamala Harris, and he says, you know, my vice president Trump. I mean, this guy doesn't. It's gone. He's gone, and I don't know. They're going to have to do something, and I just don't see, even if you know. And then you have to ask your question: if you're if you're a supporter of the Democratic Party, you got duped. You're the dupe that they wanted. You're the chinless wonders and dupes. You know, don't you feel any kind of like you've been wiped off on, that you've been used and tossed? I mean, it's unbelievable. And yet people are, like I said, those awful half dozen elderly, middle-aged white women that didn't see any problem with any of this. They, you know, maybe it was a put-up job. I don't know. I mean, if I would have been the reporter, I just couldn't take it. I don't know how, you know, how much money do you have to be paid to go along with these charades? I mean, is there any principle? Do people have principles anymore? Say, look, I'm not going to go out there while these women look at what I'm looking at and then sit there and say, yep, I don't see an issue. That's terrific. You know, Joe from Scranton cares about me in America, and not challenge them and say, are you watching what I'm watching? This guy doesn't know what's going on. Of course, that's not allowed though, right? You won't be allowed to be on there if you know, people always have said in the comments here, a few people have said, wow, you should have a bigger audience. How am I going to have a bigger audience? You know, somebody told me I should be on TV. They're not going to put this kind of discussion on TV. This is all, it's all regulated. It's all propaganda. They actually cut and paste these videos. They're not going to tell the truth. I mean, there's no way. I'm surprised I haven't been banned from YouTube yet. But anyways, I don't want to keep going on. This is a real mess. And, you know, I remember they said, I think it was Thomas Friedman said, not, you know, after we won the Cold War, we weren't going to be the world's superpower. We were the new hyperpower. Nobody would ever be able to compete with us or supplant us as the world's only superpower. And this is what you got. You got Brezhnev and Cheryenko and Andropov. This is what you got. End of the Soviet Union. You know, they were in a quagmire mess in Afghanistan. The place was an economic basket case. You can see the parallels. And they had elderly, geriatric leadership wedded to an ideology that was outdated and dysfunctional, with all kinds of internal contradictions that guaranteed that it couldn't be reformed. And, you know, that sounds like the U.S. right now. And so I don't think electing Mr. Trump's going to change that, me personally. Okay. Sure. You know, you can read the decline and fall of the Roman Empire, and, you know, certain emperors came along. I can't remember the names, where they stabilized the currency for a period of time. And as soon as that emperor died, you know, the next emperor went back to clipping coins. So, you know, this is why I say that we're kind of set in stone now and rigged for heavy weather, because you're going to see a lot of chaos. You're going to see a lot of black swans and a lot of things that are really going to be really wacky. and I think are going to have the opportunity, getting back to investing and speculating, that can really move markets. And so, can you imagine? Let's just say, I mean, there's no guarantee that if Biden runs, he won't get reelected. That is a possibility. And then he dies in office, and then you have Kamala Harris as the president. Really? I mean, I can't even imagine. But such is how things are. Truth is stranger than fiction sometimes. But watch these videos, because it's actually kind of sad how this guy's being taken advantage of. It's really, at this point, elder abuse in my view. And again, if you've had anybody that's had dementia in your family, it's not cool, man, to be doing this. But there's a lot at stake. You're talking about most powerful job, most powerful, wealthiest, whatever deal in the entire world, being president of the United States, or being around that power zone. So I don't know. I know Jill Biden doesn't want to give it up, because she was nothing before this, and she'll be nothing again. And you can see what's happening. And they got Hunter Biden in there now, and the press doesn't say anything. It's shocking to me. But anyways, well, actually it's not, but enough on that. That's it for this week, guys. Appreciate the support. We've been putting out a lot more content. I hope it's been useful for you. We going to try to get some more interviews going with some people that aren't just on the typical interview circuit, and have some kind of unique conversations about some things that I think are some potential opportunities, like I've talked about, outside of what everybody else is talking about. We always try to be on the edge here at the Actionable Intelligence Alert newsletter. All right, guys, that's it for this week. We'll talk to you next week. Thank you.